Welcome back. Canadian bank earnings are front and center for Canadian investors today. The Bank of Montreal beat by a wide margin, and so did Bank of Nova Scotia. But credit provisions were a factor in both cases. Joining me from Kelowna, British Columbia, is Gavin Graham, Chief Investment Officer and Portfolio Manager at Spire Wealth Management. Gavin, great to talk to you as always. Let's begin with Bank of Montreal. What did you see there? What stands out?
Well, I think the strength of their capital markets and wealth management business was the big driver there. We were looking at sort of 25-35% increases in the earnings from there, which is unsurprising given that we had a 25% up year and a pretty strong fourth quarter, especially through Mr. Trump's election. The interesting thing perhaps was the fact that the provision of credit losses jumped from sort of 650 million-ish to 1.1 billion. It's a fairly sizable increase. Nonetheless, the earnings were pretty strong. And I think, correct me if I'm wrong here, Paul, they actually increased the dividend 5%.
They did indeed. Talk to us more about that increase in provision for credit losses. I spoke to an expert in the banking sector earlier this morning. He says the banks are on their way now to peak loan loss provisions. He says it won't be too long before loan losses begin to come down. Do you share that view?
Absolutely, and I think, in fact, people had felt that was what was happening towards the end of last year, and there were a couple of banks where PCLs were actually substantially lower. But with the tariff uncertainty, I think the banks are being pretty conservative about the PCLs they're putting in place. They're in essence doing sort of belt and braces to ensure that they're not taken unawares in the event that, and as you know, Paul, the modelling that's been done by the Bank of Canada when we last had tariffs being imposed by a Trump administration back in 2018-19 said there would certainly be a noticeable downturn in the economy, even if not a full-fledged recession, because of course we don't know exactly how big the tariffs are going to be or what they're going to be on. So I think the banks are erring on the side of being conservative. But yes, you'd have to feel that this is probably, if not the peak quarter, then next quarter, which would be through to the end of April, by which stage we should at least have some clarity on the tariffs, that will be the peak for PCLs.
Just before we move on to Bank of Nova Scotia, Bank of Montreal is one of the Canadian banks that has a sizable U.S. banking operation. It got bigger a couple of years ago with Bank of the West as an acquisition. In the light of trade tensions between Canada and the U.S., is that an asset or a liability, the big U.S. operations?
Well, I think, as one of your previous guests was saying earlier this morning, in essence, BMO is a way to get exposure to U.S. commercial banking via a Canadian bank, because that Bank of the West deal was a big transformative deal, took them out of their Midwest center with Harrison, Marshall, and Ilsley, and gave them the Pacific Coast and the Western states. And so you'd have to feel it is a benefit for them. The difficulty, though, is, and we saw it with TD, with its bigger US operation, was not as profitable as its Canadian operation, because if you have a nice cozy oligopoly, as the Canadian banks do, as opposed to a lot of banks and a fair amount of competition in the US, it's not as profitable business. Nonetheless, it's a nice diversifier. You're actually operating within the US, therefore you ought to at least be a little bit of a hedge against continued trade tensions.
Okay, and just as a correction to something we said earlier, Bank of Montreal did not announce a dividend increase today. It announced a dividend hike the last time it reported results in early December, and that was a dividend hike of 2.5% to $1.59 Canadian per share per quarter. Okay, let's move on to Bank of Nova Scotia. Also a clear earnings beat and a profit of about $2.4 billion if you set aside a loss it took on the sale of some banking operations in Latin America.
Absolutely. And again, that was driven by wealth management and capital markets again. So we're seeing a theme emerging here. Interestingly, its increase in PCLs was only a couple of $100 million, up to about $1.1 billion. So that actually, I think, was a bit better than was expected. As you say, if you set aside the $1.4 billion, the write-off on the sale of its Colombian business to bank, I think it's Davivienda, which is one of the largest Colombian banks, they have ended up with a 20% stake in a larger, more profitable operation, because one of the problems with Colombia was it was never really profitable, it was subscale. And that's all part of CEO Scott Thompson's focus of the bank on North America. They bought the 15% stake in KeyCorp, and they specifically said they're looking to expand their business in Canada. And I think that they've specifically mentioned Quebec as an area of interest.
Okay, your view, Gavin, on the Canadian banks at large in an environment where the Canadian economy may get hit by very substantial tariffs. As you know and our viewers know, Donald Trump yesterday said that 25% tariffs are coming soon to Canadian products shipped into the United States. What's it mean to the Canadian economy? What is the read-through to Canadian bank shares?
Well, for a start, as we mentioned with Bank of Montreal, it and TD and Royal Bank all have large US operations, which are a little bit of a hedge. But secondly, also, if we are going to see a refocus on domestic business, on breaking down interprovincial barriers, on reallocating the focus of Canadian exports away from an exclusive focus on the US towards other markets, that's obviously got to be good news for the banks. They will be hit if there is a slowdown or even a recession caused by the effect of tariffs being imposed, but we don't know what those tariffs are. We don't know exactly how large they'll be and whether there'll be any exemptions or cutouts. One would have to say that the banks, especially given the strength of their capital position, the fact that they're paying you 4.5% to 5.5% dividend yields, and the very strong competitive position they have. You might remember, Paul, it was one of the concerns Mr. Trump had was that, US banks can't operate in Canada. In fact, some do, but what they haven't done is put a retail branch network in place because it's so difficult to compete against the big six banks, and that's a very big strength for them. So if you want to be anywhere in the Canadian market in the present uncertainties, the banks are a very good place to be.
Okay, and I'll tell viewers, by the way, on conference calls today or in their statements, both banks cited the tariff possibility as something that could drive provisions for credit losses higher. I'm interested in your view of valuations in the sector. BMO is trading at about a 14 times multiple. Bank of Nova Scotia trading at about a 10 times multiple. Those are forward-looking price earnings multiples. What do you think?
Well, Scotia is the cheapest bank. Unfortunately, it's been the cheapest bank for a long time, which is unfortunate given it's a personal holding. But, it's you are being compensated because you're getting a 5.8, 5.9% dividend yield, although it hasn't been raised for a couple of years, unlike the other banks. So Bank of Montreal has performed much better. The Bank of the West acquisition was a big transformative acquisition. Its strength in wealth management, I think its ETFs, which was started 15 years ago or thereabouts, are now 120 billion or thereabouts. So it's been a very, very successful, even if relatively low margin, initiative for them. But in essence, you'd say that they've actually performed pretty much of a muchness over the last year. And on that basis, especially if Mr. Thompson does continue with this refocusing on North American assets, which the market evidently regards as being more attractive than Latin America, which is why Scotia's underperformed, then probably Scotia's the place to be.
Gavin Graham, thank you a great deal. Gavin Graham is Chief Investment Officer and Portfolio Manager at Spire.